Welcome to this week's live ASX strategy session. Thanks for joining me. Great having you with me for another show. Heaps of interesting things to go through today with gold on the move again, some movement in the stock markets, interesting things in uranium. So plenty of interesting things to go through today. And then also your stock codes, any stock codes you'd like to have a look at, get them ready for the second half of the show, and we'll get up the charts and go through all of those. As always, everything today, general commentary only, doesn't take your personal situation into account. Having been through all of that, let's get into this week's first chart. And we're going to start off with the ASX 200. And well, the ASX 200, I think it's now crunch time. I think it's crunch time for the local market. Prices are now just below the moving averages. Will it be a case of sell the rally and a retest of the lows? More on this in a moment. And then over in the US, the S&P 500, well, it's been up 7 months in a row. There's been 16 similar winning streaks since 1950. In a moment, I'll tell you what previously happened over the next 6 months. I think you'll be surprised. But before we get to that, let's start with this latest price action in the ASX 200. The big development, big development this week has been a break above this resistance zone at around 8,600. You can see this running across here. There's a previous all-time high. Technical activity throughout the year, and now prices have just started to get through that resistance. So far, it's just a nudge. It's just a nudge above the resistance zone, but it fits with the buying pattern that we've seen over the last few weeks. And that buying pattern is the strong rally. We've had the strong rally off the November low, and that indicates, and I think that indicates an urgency to get back into the market after that previous sell-off. So the big sell-off, strong bounce, some urgency to get back in. And then even more importantly, the ASX 200 has been able to hold those gains over the last few weeks. And this is a telltale sign of buying interest on the dip. It's a sign that stocks are being accumulated, and that I think the buyers are now setting the tone. Now, I said in the intro that this is crunch time for the ASX 200. And the reason for that is that it's now directly below these moving averages, and directly below moving averages, which are also declining. If the rally is going to be sold, this is the classic place. This is a classic place for selling to emerge as a rebound in a market closes in on declining moving averages. So a recent example of that, it was back in March. We had the strong sell-off. We had a nice bounce off the low. Didn't quite get to the moving averages, but got towards them, and then the selling pressure came in, pushed the market lower. We can just go back. I can probably find you another quick example. Here's another example from 2023, where there'd been a sell-off, a rebound back to the moving averages. That's where the selling came in, pushed prices down again. So here we are again, back at the moving averages. What happens now? If I was looking at this chart in isolation, just called up this chart, just looking at this on its own, don't know what market is, could be a stock, could be whatever, just looking at this price action on its own, I would be a bit concerned with the current setup. And my key concerns would be the declining moving averages, and that prices were consolidating beneath those moving averages. So when that happens, it does open a window of vulnerability, and this is something I think we should be aware of. It do need to be aware of that structure. But I think there's more to this than a single chart, and I think it's the sum of the parts that provide the best view of where I think the probabilities lie. So I'll show you what I mean. Let's jump over to the equal weight. So this is the ASX 200, the market capitalization index. Now look at the ASX 200 on an equal weight basis. And when we look at it on an equal weight, this provides a very different picture to the ASX 200. While the ASX 200 is below declining moving averages, look at the equal weight. It's been consolidating above moving averages, which are still generally rising. The 50-day has come back and now it's flattened out, but the 100 is still gently rising. And so prices are consolidating above moving averages. So it's a very different situation. I also like that the pullback we've had from the October high, it came back to the 100-day moving average, then dipped a little bit below the 100, but that's not a great problem. But then from there, there's been a strong rally off the low, and that's a sign, of course, of buying intent when you get a strong rally off the low. Then look at the latest consolidation. It's shallow and it looks corrective in that it just comes back and there's no momentum to it. It's just sort of chugging sideways to slightly lower. That's a corrective looking move. So this is a chart of a market that seems to be preparing for a move higher, not a move lower. The most important point here is the equal weight. At least I think the equal weight is a better gauge to what's happening in the broader market than the ASX 200. And that's because it's not dominated by a few big stocks. So the equal weight, it's basically 200 stocks that are weighted equally. It's not dominated by BHP and a few big banks, a few big miners and whatnot. So why does the ASX 200 look like it's struggling so much when we look at what's going on in the equal weight? Well, I think it comes down to weakness in the big banks. So let's quickly jump to the financial index. This is the ASX 200 financials. And so this is just starting to rebound now. And it has been weighing down the ASX 200. It's not helped by the fact that CBA, which is also the largest ASX 200 stock, is down around 21% from its June high. So I think the financials are distorting what's generally playing out across the local market. I think the good news here is that financials, firstly, they've stabilised. We've discussed this. I think we talked about this last week, that they've started to stabilise. And now today, just on Friday, we're seeing prices start to move up with a bit of strength. The key will be to see, I think the key now will be to see prices back above these moving averages. And once above the moving averages will then themselves start to turn higher. I think the next rally is important. Does this push we're seeing on Friday gain momentum, or is it going to be quickly sold into? And this is something to watch over the next few sessions, or even the next couple of weeks. I think while financials have been a drag on the ASX 200, the materials, which is where the big miners are, well, they continue to be a tailwind. So just quickly looking at the ASX 200 materials index, and you can see these continue to push higher. And on Friday midday at filming, it's they're at new all-time highs, and that's following the breakout from this 6-week trading range. Just recently, we've been talking about that, and that breakout's continued to gain momentum. We've also been discussing in previous weeks that materials are breaking out of a 3-year trading range. You can see this larger trading range that prices are breaking from. So these upward breakouts are all good things, I think, for the materials, and being such a large part of the ASX 200. I think it's a supportive thing for that broader local market. I think that while materials remain strong, it's hard to see a breakdown in the ASX 200. Just quickly coming back to the ASX 200, overall, this is a market that I want to remain long. I'm continuing to treat this pullback from the all-time highs. I'm continuing to treat it as just that, as a pullback within an upward trend. And I think the odds favour a rally. I think the odds favour a rally above these moving averages in the near term, not a breakdown to new lows. I've been seeing some interesting buy signals through my Motion Trader service through the week. If you're interested, if you want to see what stocks are on the move at the moment, you can get a free trial in the description section below. There's a link there. Click that, lock in a free trial, and see for yourself. Okay, so let's move on to the US market next. Firstly, if you're getting some value from this, please hit that like button. Click the like button. Leave us your comment. Tell me what you think. Are we about to break back above the moving averages, or are we heading down to retest the lows? Always interesting to sort of like see what everyone's thinking and how people are managing this situation. But yeah, whilst you're thinking about it, please click that like button. It helps me so much because then YouTube shows people the video. If no one's clicking, no one's commenting, YouTube's ignoring. So please do that. Helps a lot and makes the videos continue to happen. Okay, S&P 500 next. So this has been a fascinating week for the US market. On the surface, you might think this chart of the S&P 500, well, maybe you think, look, it doesn't look anything particularly notable over the last few days. And that's largely true. It's really just been moving sideways for a couple of weeks now. And that follows this sideways period follows the strong rally off the 100-day moving average about 3 weeks ago. As we discussed last week, the strong rally coupled with sideways trading above the moving averages, well, that's bullish price action, as it indicates buying of the dip, and that's continued this week. So I think all good there. But it's what's happening below the surface that I think is so fascinating. And this is something that I think most people have probably missed, because most people just happen to call up the S&P 500 or the NASDAQ, or those big well-known indices. Let me show you what I mean. Let's jump to the S&P 500 equal weight. And this is where it gets really interesting. So look at this. The equal weight has broken to a new all-time high, and in doing so, it's now leading. It's leading the S&P 500 index, and the S&P 500 index. Well, just to remind you, it remains below its October low, whereas the equal weight, well, it's at a new all-time high. So the broader market is outperforming the big tech stocks, at least at this point in time, and so this isn't a rally. This isn't a rally built on AI. It's a rally in stocks with exposure to really the broader economy, which I think is bullish for the market generally. This week's rally saw a breakout from a 2-month trading range. We can just put this range in on the chart. So probably a little bit over 2 months now, actually. So it's probably like, what is it? Probably a 3.5-month trading range now. So I got this breakout from the trading range, and this has been fascinating on its own. And that's because the equal weight had a false break to the downside in late November. You might remember what we said last week about the false break from November. We discussed how the false break was a classic sign that buyers remained the dominant force. And that when fear is in the air, and if you just remember back, you just got to remember back, cast your mind back about 3 weeks, how much fear was about, that there was some sort of a bigger fall in the makings. When you've got a situation when you've got fear in the air and the breakdown fails and pushes back higher, it tells us that the path of least resistance remains up. That's what we spoke about last week. And that's what we're seeing this week with the breakout in the equal weight. I thought this breakout may have taken another week or two. I was thinking maybe we could get some consolidation just below the highs and then a late December break. But breaks are break. They happen when they happen. Fine-tuning timing is always tricky. I think the most important thing we can do is identify the path of least resistance and be positioned accordingly. And the clues the market's been giving us has been that remains up, and that's the situation here. The big shift we've seen in the last 2 weeks is, I think it's the really big shift I think we've seen the last few weeks has been the improvement in breadth. And so breadth, when we talk about breadth in the market, that simply means more stocks are participating, and higher participation is a key it's a key indicator to a healthy market. The equal weight is showing us there's participation. And I'll show you something else that shows we've got this broader participation coming through. Let me just change over. I'm going to look at an indicator. So this is showing the percentage of Russell 3000 stocks above their 100-day moving average. So the Russell 3000 is a broad measure of US stocks. Don't confuse it with the Russell 2000, which is the small caps. The Russell 3000 covers, I think it's something like 95% of the listed US stocks. And we looked at this a bit in recent times. And we discussed a few weeks ago how moderate pullbacks often finished around this region. So just explaining this indicator quickly, the numbers down the side are percentages. So when you see 36%, as was recently, it's telling you that only 36% of stocks are above their 100-day moving average. So most stocks below their moving averages. And what we've discussed recently is that moderate pullbacks often finish in the mid-30s when there's around, say 30, 35, maybe 40% of stocks above their 100 day moving averages. That's where a lot of moderate pullbacks tend to base and turn higher. And we've also noted the strong rebound, the strong initial recovery a couple of weeks ago back towards these moving averages. And now we have the indicator here. It's back above 50%. It's up above. It's now at 60%. So 60% of Russell 3000 stocks above their 100-day moving averages. So this is a clear sign. This is a clear sign that participation is broadening. Back to the S&P 500 briefly. I mentioned at the start of today's session that the S&P 500 has been up 7 months in a row. And this has happened 16 other times since 1950. So it takes us back to the April low. There's our 7 months in a row. It's happened 16 other times since 1950. Did the market keep performing or did it run out of steam? Well, I'll tell you what it did. It's well, firstly, like what's interesting before I do that is like our mental wiring is such that we often hear about winning streaks and then we think, well, the winning streak has to come to an end. 7 months in a row, like, really, surely, it's got to stop. We've got to have like a down period for sure. That's what we tend to think. That's what we tend to think with winning streaks. And ultimately that does happen. A winning streak will end. But winning often leads to more winning as well. So that's the power of a trend. And that's why I often talk about letting a trend surprise you on the upside. So what happened those other 16 occasions? Well, 6 months later, the market was higher in 14 out of 16 cases. The average gain was 7%. Now, if you're wondering about the two losing periods, they were down about 3.5%. So hardly a calamity. So the next 6 months, the next 6 months is going to bring its own unique price action. What's happened in the past doesn't tell us what's going to happen in the future. It can just it can help frame our thinking, but it doesn't tell us what's going to happen, of course. But as this stands, this is a bullish trend. Price is above moving averages, above the moving averages, and the moving averages, the 50 and the 100-day, they continue to trend higher. So this tells us the path of least resistance remains up. We always need to manage risk. Now is no different, but a winning streak is not a bearish signal. The trend is up and it's supported by that broadening participation that we've been discussing. So that's bullish until we get information to the contrary. All right, so we're going to jump over to the small caps now, and you need to see the small caps. It's really interesting what's happening there locally and in the US. We've got the commodities. We're going to go through your stock codes as well. So lots of interesting stuff always appears in that. But this wraps up the free section. So if you're not a strategy session member, there's a link below. Click it, come in. Doesn't cost you very much. I'm sure you're going to get your value for money plus more. Think of doing that. We go through so much more stuff. This is just the start. All right. So over to the Russell. Let's go over to the US small caps.